What's good, guys, and welcome back to another episode of the Learning Center here at ElementaryFX. For this episode, we'll be looking at 3 common Fibonacci mistakes that traders tend to make while using Fibonacci, retracements, and extensions. So, as you can see from the chart, this is the Euro USD on the 15-minute chart, and if you look to the right, markets are currently live and open right now. So we'll be doing some learning and some analysis at the same time. So to kick things off, the first mistake that some traders make is consistency, and what this means is that they have a mistake of being inconsistent with picking their swing lows to highs or highs to lows. So before I show you the wrong way, I'm just going to show you the right way of how we do it. Let's have a look at this swing right here. We have a very nice swing low to swing high, and the right way to use it for a Fibonacci retracement is to have a look at this candle right here, this very nice push up. And if you want to use a retracement of that, we should have it from this wick right here all the way up to this wick right here. If I were to use the magnet tool, which is very useful in having precise and exact points of Fibonacci retracements, you can see that the magnet tool is straight away attracted to this wick, and this swing high is attracted to the wick on top. So this can confirm that we have a very nice and precise level of Fibonacci level. So the right way to do it is wick to wick. However, like I said, people do make mistakes and have their Fibonacci retracements from the swing low, the wick, all the way up to the body on top. And let me show you why this is wrong. Let's say we look at this candle, and instead of closing here, it closes below here. So if we were to pull it here, we can see that these levels don't line up exactly. If we use our wick to the body, for example, this candle right here, this bullish candle closed around here, and we decide to use from wick to body, you can see that price pushes down but doesn't touch certain Fibonacci levels. And that's important, because for this case, as you can see, if we have consistency from our wick to wick, we can see that price made a push up before rejecting the 618, and this gives us an alert for a potential GARTLEY pattern, which is something I'll go through in a few minutes. So this is the first mistake some traders tend to make. It's either you have your wick to wick or your body to body, and never wick to body or body to wick. So that is something that you might want to look out for in the future. The next one is Fibonacci extensions, and I've seen many traders make this mistake. Let's have a look at an extension. Let's have a look at this swing right here. Swing high all the way to swing low. Yep, and usually Fibonacci extensions are done like this. The right way they're done is if you have a swing high to swing low, back up to your swing high. This is the right way, and the reason why I say this is the right way is because if you use a Fibonacci retracement, let me just show it to you. Fibonacci retracement of this same swing high to swing low, and if you reverse that and you click the 127, you can see that it lines up with the same extension. The reason why I bring this up is because some traders some traders do this instead. They have their swing high to swing low, and instead of going back up to the swing high, they go up to the next retracement. And as you can see, where does the 127 end up? It ends up way below this, and this is not the right way to do it. I have 2 reasons to justify it. One would be the previous one I showed you, the retracement. The reverse retracement brings a 127 exactly here. And the second justification of this is that if we have a potential GARTLEY pattern, which we do right here, and I'll go through it in a bit, the decompletion being below our exit, doesn't that technically invalidate our pattern? And so if you're looking for patterns and you use this in extension, this swing right here, you have swing high to swing low, back up to the next retracement, and you have your extension here, the 127 completion right here. Wouldn't this technically invalidate the pattern because the decompletion is below the X leg? Typically, a GARTLEY pattern has their completion above the X leg. So for this case, we have X to A, A to B, B to C, and a CD completion right here. So I've just shown you some mistakes that traders make while using retracements and extensions. However, at the same time, we also have a potential completion of a GARTLEY pattern on the Euro USD. And that brings me to the next mistake traders traders tend to make. Never use Fibonacci alone. And what does that mean? That means that if you might have a very nice rejection of price at a certain level. Like for this case, let me just show it to you. We have a very nice level right here. Price rejects the 618 level very nicely right here. However, in this case, let's have a look at this pattern. This potential pattern that we have right here. I think the 127 came up around here. Okay, so for practice, let's have a look at some let's do the extension again. Let's do it like this. We have swing high to swing low. Let's use the magnet just to have a more exact level. Swing high to swing low, back up to swing high. You can see that at 127 level comes up around here. And what I mean when I say don't use Fibonacci alone is that we should always while using Fibonacci's, we should always confluence it with something else like structure. For in this case, if I were to draw a line in this area, do we have a good enough reason to enter this GARTLEY pattern, this bullish GARTLEY pattern? Do we have a good enough reason to enter? And just because it's a bullish GARTLEY pattern doesn't mean it gives us the right to enter, because we do need more justification to suggest that this area right here will hold as a potential structure area. So never use Fibonacci alone, and what that means is that the simplest way to combine something else would be to use structure. And as you can see, if I were to just erase the GARTLEY so it looks nicer, we have decent structure around here. Not the best, but we do have decent structure. We have support. We also have support right beside it. Possibly a false breakout right here. And just get rid of the magnet. The magnet can get quite irritating at times, but it's quite useful, guys. So we have a false breakout here. Also another false breakout as a form of resistance before price comes back down and rejects this area twice. So you can see that we have Fibonacci lining up with a decent structure area. So that's why we can use this potential pattern could be quite a good pattern if it completes. So just to recap, consistency, we should always have wick to wick or body to body depending on your style. Number 2, Fibonacci extensions are from swing highs to swing lows, or swing lows to swing highs and back down to swing low. It's never swing high to swing low back to retracement, or swing low to swing high back to retracement. So just to repeat that again, it is never swing high to swing low back to retracement. It is swing high to swing low back up to back up to swing high. And that is how you use the Fibonacci extensions. The last one is never use Fibonacci loans, because Fibonacci loans will not justify a certain position that we may want to enter. We should always combine it with structure, which is most important, possibly some RSI divergence, or depending on which indicators you use. So this has been the Learning Center here at ElementaryFX. Thank you guys for joining me. Just to keep in mind, we do have this GARTLEY pattern, so I will update you guys in the private trading group. Thanks guys, and I'll see you guys on Tuesday for our daily market analysis.